With that, let's get started on fundraising and scaling. So ladies first, Grace. In 2022, you raised Asia's largest seed round from a climate tech platform, and you said that you were 5 times oversubscribed. Could you please share with us your core strategy for becoming a company that everybody wants to invest in?
I don't know if that moment will ever happen again. I hope so, but when it did happen, I told my co-founder, enjoy it while it lasts. But again, I think the role of timing and luck plays such a big role in a founder's journey, more than we know. So at that time, we just came out of Y Combinator. It was the peak of all climate regulations around the world, about to open up like a, hundreds of billions of total addressable market. And so we were just at the right time, at the right place. Of course, I have an amazing team and amazing product. But there are definitely some scientific ways to fundraise well, and some of it would include, having a very short, condensed time to fundraise, right? Like have 100 chats within 3 weeks, and so you're able to line up the offers to make the best decision. The best offer, because if you start too late or too early, you will not be able to compare, right? And so then with that intense timeline as well, you create a lot of competition amongst VCs. And VCs among us know, we all talk amongst ourselves. Everybody knows what's the hot deal in town. And so yeah, all of that together, we were very lucky to be in the position that we were in. And this was just before the Russia-Ukraine war. So I knew I had to lace up my war chest. We ended up raising double the amount that we wanted.
Thank you for that. And now to take funding to the next level, Anuj, can you please explain to us how you got to almost 400 million in funding, and what funding challenges you faced along the way while you were scaling?
Hopefully funding requirements are a function of the business that you're creating. Investors really look at the promise of value creation over a period of time. So the responsibility is actually not just in raising large amounts of capital. I think as founders of all of these innovative, interesting businesses, I think a bigger challenge and a bigger promise and a responsibility, really, as you guys would know, is to generate adequate amount of shareholder capital, shareholder value. And my employees are my shareholders are of course my shareholders, I am my own shareholder. So, I think a lot of what I'm sort of saying right now is, of course, a lot of gratitude for the journey over the last sort of 8 to 9 years, wherein I think we've done a good job in terms of capitalization and making sure that our balance sheet is strong and our allocation of capital is to the right efforts, and they hopefully, and I'm pretty sure they will, generate the right kind of sort of value for the company. The promise is not just in raising, the promise is in creating like a highly governed structure, focus on a lot of fiduciary responsibilities, but making sure that we are now setting the company up, for returning the money. So my responsibility now is to actually return the money, to my shareholders. But I think in the journey, if I could take another 10 seconds, we as Livspace and I personally, my co-founder and my team, we've been very lucky to actually experience and work with some of, frankly, the best brands in the financial platforms market. Names like KKR and TPG Growth and Goldman Sachs, Jungle, Bessemer, IKEA. You name it, we have it sort of on the cap table. Many prominent families are represented on the cap table. So we've been very lucky to essentially experience how various asset classes think about participating and partnering with companies like us. What's the horizon? What's the kind of return profile they have? So yeah, fairly lucky in terms of what we've seen in the last 8-9 years.
And while on the topic of getting funding, let's talk about the phrase that Kohki speaks about, which is there's a lack of patient money. Kohki, can you please first elaborate on why you think money is getting impatient, or money is impatient, and why it's hard enough for some industries like medtech and semicon to basically raise funding?
So I think the time horizon differs from different types of businesses, and when We first started this business. There were only like private equities or venture capitals, which we thought impatient in order to nurture industries or wait 10 years, 20 years for certain technologies to mature. So I think different types of structures is needed. So a couple of examples in our group. One is called ATAC, Advanced Technology Acceleration Corporation. This is like a building an ecosystem to support researchers build their own company. We don't have a particular time horizon, so we don't have to rush them. So it's patient money. Another one is called JPIX, Japan Platform for Industrial Transformation. This is a corporate structure, so we don't have to exit. So we can invest into different types of asset classes, and depending on the type of business, we can set the right time horizon. So I think this kind of different structure is needed in order to support the industry.
But when you say long horizon, how long is long?
For our semiconductor business, company called FMSC, not TSMC. This one, it's about, we are looking for like 10 years horizon. But if you talk about the regional transformation, we look at 20 years, 30 years. Yeah, so that's why we don't think about exit. Yeah, we just collect the dividend and try to grow the group.
So if anyone has businesses here that takes 20 to 30 years to harvest, go to Kohki here. But Anuj, when we spoke, you disagreed that VC money is not patient enough. Is this because the B2C platform doesn't have this problem?
Like money has never been patient. Money should be patient. So I think that's where I'm coming from. And I think our discussion when we were having the other day, my take is that a different fund structure will actually cater to different value creation horizon, as I think that's the point you were making. So when you're doing consumer internet startups, I mean, frankly, the model of the entire venture capital private equity industry was created out of, I don't know, Silicon Valley and New York, and you could argue that itself is up for some degree of transformation as is happening to allow for higher hold periods and so forth and so on. The classic venture model works on 8 + 1 + 1, right, if I'm not wrong. So that assumes that you will be able to build a company, generate value, return the capital, and so forth and so on. I think in ideas like clean tech, deep tech, many new emerging transformation technologies, and I think I was having a chat with the founder of a fusion technology yesterday at the same conference in Sentosa, and the models are already 10 + 1 + 1. So you're kind of already in your mind thinking that there's a 12-year horizon. But the formats of capital that I feel will become more relevant for these kind of ideas are perhaps like more sovereign capital or strategic capital, or the nature of which Kohki's experience in Japan, or family offices, other innovative formats like debt and so forth and so on. But I think there has to be some degree of transformation in addition to the classic venture capital model to be able to allow value creation to happen without unnecessary stress and impatience getting created in the market. That's what I feel.